Hi, I'm Ernie Bernstein. I'm president of Bernstein Planning and Wealth Advisors. This is one of my advisors, John Donez. Today we're here to talk about the 4 headwinds in the market right now. And those headwinds are, and also, should you be investing, which is very important. We're going to do that, basically answer that at the very end. John, right now we see a lot of things happening in the market. I want to stress one thing. Don't panic.
Absolutely, yeah. It's exactly what I was going to say. Just don't be scared of the corrections and the things that are happening in the market right now. We've had 3 or 4 years of really good markets, solid upwards of 18 to 20% growth.
Above, yeah.
So, but this isn't a time to, push the eject button and get really scared.
Yeah, so here's the thing. Make sure you're not panicking. There's not volatility. When you see downturns in the market right now, buying the dip is gold. Just buy the right stocks. That's the whole key thing. So the first headwind is the geopolitical risk. We have a variety of things happening right now, John. So you give your opinion first about the geopolitical risk we're facing and how should people react.
Yeah, so initially we kind of thought that this tension in Iran was going to last maybe 2 or 3 months tops, and now it's kind of lasted upwards of close to 5 or 6 months. So we're constantly having a peace deal and then another treaty, and then something else happens, right? So there's a lot of uncertainty what's happening with that geopolitical tension happening in Iran. There's also, what's going on in Venezuela, China, Russia, in regards to oil and gas right now. So that's the biggest geopolitical factor right now, is what's happening with that sector and, the price of crude oil and just volatility of that.
Yeah, so here's the thing. The market's kind of ignoring a little bit of what's happening with the Iran war right now. You see, the biggest thing is the straits are not open. And with the straits not open, that's the biggest reason why the market's, that's one of the reasons why the market's not taking off. That's going to help on energy prices. We'll talk about inflation in a second. But when the straits open up, that's going to help a lot in a variety of different ways. And I guess let's just go ahead and bounce into that right now. In inflation in itself, what's causing the inflation that we've had? We've seen in the last 4 years, 5 years. 5 years now since 21, we've seen a 25% increase in inflation. And you think about that, that's big. If a loaf of bread was $2 and now it's $2.50,
Yeah, well, just the buying power of the dollar is not what it is or what it has been. So one of the biggest things right now is obviously the geopolitical tension that we're talking about, the cost of oil and gas going up. Everything has to be transported through some variation of oil and gas, right? So inflation rises because, just cost of goods and services increase. That's like the obvious one. The next one would be just, jobs data and different data coming out, that there's a lot of uncertainty with the rates, which I don't want to get into that yet because that's another topic, but that's causing inflation to just have a little bit of uncertainty as well. There's a little bit of uncertainty looming with what's happening within the Fed and different things like that.
And we just need consistency. In other words, this Iran deal gets signed, and they don't have a bunch of guerrillas because they really don't have much of a military left whatsoever. They just have the Iranian Guard. Once the guerrillas are basically stomped out, or they actually sign an agreement and stick to it, which would kind of be a miracle.
Yeah.
Once we have several months of no guerrilla warfare in the sense of them trying to shoot missiles into the straits and oil's freely going through the straits in itself, then that's going to basically, like John mentioned earlier, that's going to cause oil to go down and cost of goods and services to go down. Cheaper to get your gas, cheaper to transfer those goods and services. But it has to be for several months. It's just not going to happen because we have a 1 month stand down. And then the next thing overall is the Fed rate, so as we touched on.
Yeah, so with that, there's a lot of different data coming out that has priced in certain things, but then hasn't seen other things. So unemployment has continuously kind of moved and jumped around depending on certain things. I know that a ton of Fortune 500 companies are, cutting jobs into certain different things with their expansions and so forth. So unemployment data, the CPI is coming out, and then just GDP numbers globally are all kind of all over the place because right now the bottleneck of what's happening geopolitically with Iran and different things.
With the jobs market, the last 2 job reports, it was very strong in the sense of reasons why we should not be raising rates. And that's a big plus for the Feds, tomorrow with Chairman Warsh coming out. I don't think he wants to. I don't think he will. And the market doesn't think either. But if he gives any type of significance that he's not going to be raising rates. In fact, he could look at lowering rates. You see the market really take off. The last thing overall is the AI spend. We're hearing it all over the news, all over the CNBC and the market channels, the Fox. And what's your opinion about the AI spending and how it's affecting the stocks in the Max 7?
It's definitely affecting them. Obviously, they're all taking a little bit of a tumble because of how much CapEx spending they are using. But it's kind of a double-edged sword, right? Because Apple for the longest was getting hindered because they weren't spending as much on AI, and then they're saying, well, you guys aren't profiting enough, you guys aren't making enough revenue and not looking toward the future. So it's really
and now they're benefiting from it.
Exactly. So it's where you want to put your eggs, where you want to kind of these tech companies are really trying to figure out how much they want to put in budget into those things. Some of them have reaped the benefits of it for the longest time: Nvidia, Broadcom, Google, and so forth, but they're having a little bit of a correction because now investors are taking a little bit of a step back and saying,
Are you spending too much?
Are we spending too much on this?
Yeah.
How is this going to profit 5-10 years from now? What's the outlook here? How is that going to look? So,
and not that Apple is not a great service they provide in phones and systems
Absolutely.
and everything, but they're benefiting from being a little bit more cautious on the spend. However, there's a lot of revenue starting to come in. It's going to take more time to judge that AI. Now, the last part is very, very important. Why should we be investing the rest of the year, or should we be stepping back? Now, I'm going to give you a few reasons, and John will too, why you should be investing. As I said earlier, don't panic. This is definitely a time to basically take some profits on some of these AI stocks. It's not normal for Micron and others to be up 200 or 300% in 1 year, right? That is not normal. And some of the younger generation out there is thinking this is the market all the time, and it's not. It takes time to build this up. And Nvidia is not a bad buy right now. They've gone down. There's really no reason. Their revenue is just busting out. Remember, analysts are always predicting what the next rate of return should be, and they don't come. And that quarter comes out, and their analysis is they suspect 80% growth, and it's only 75 in the stock. It's just stupid. If it's high revenue, as Warren Buffett says, watch the cash flow. But why should you be investing? Buying a dip right now. My thoughts is this: the first quarter of this year, they expected S&P 500, those 500 companies, to return overall 14% profit. It came out at 28, and then you've seen April and May, the market jump. It had a nice rally.
Yeah.
Now the second quarter, they're expecting a 24% jump in the S&P, which is high, 10%
That's a
more.
high expectation for the market.
And here's the thing: about 35% of the S&P 500 reported its earnings so far.
Yeah.
86% has met those earnings or exceeded them, but we still have 2 quarters to go.
Yeah, it really boils down to you need to really take the emotions out of it and look at the numbers, right? We obviously like tech companies. We're not saying to immediately take out of tech companies, but if it's become a portion where it's 10, 15, maybe even 20% of your account, take some gains, move it into something a little safer, and keep that long-term goal kind of what we want to do. Everyone talks about 60-40 split of equity, fixed income, different things like that. So however you're allocated, right? But you really need to look at your sector allocations also. If you're a little heavy in tech, a little heavy even in a different one, like financials have been doing pretty well too, right? If you're more allocated in financials, let's start giving some attention to healthcare.
You're right, John. So what we're looking at is a variety of different opportunities in the market. If you have stocks that have gone up 200 or 300%, take those gains. And I'm not contradicting what he's saying, but look at depending on your age, look at safer havens. But if you're a little bit younger or you have time on your hands before you fully retire, look at some stocks that are going to grow at like Nvidia and Micron in the future. Look at the stocks that are up and coming. There are some stocks out there that you're going to see some great headwind in the future and great uprise of those stocks. They're going to be climbing mountains like crazy. That being a factor in a situation, what I'm going to suggest is this overall: make sure that you're making those suggestions and making those investments with a guided financial professional. You're more than welcome to give us a call. We'd love to sit down with you or do a Zoom with you. We operate in Louisiana, Mississippi, and Florida. Louisiana, Alabama, and Florida. but we have connections in all 50 states. We have clients in all 50 states. Yep. And with our primary mother company, Prime Capital, we have access to all 50 states. So let us know how we can help you. We can build your income plan, retirement plan, tax strategy plan. Doesn't mean nothing if you make all this money, you can't keep it.
Yeah.
Because Uncle Sam has his hands out. and also make sure you have an estate plan.
Yeah, absolutely. Just make sure everything is all put together in one basket, and make sure that the long-term strategy is meeting with what your allocation is in. But definitely don't be worried. Definitely don't be timid. This is a time where you can really assess where you're at and see where you want to be moving forward.
And take advantage of some of these opportunities right now. Buying the right stocks in a dip can really give you financial reward in the future.
Absolutely.
If you have any questions, we can help you. Look us up at BurnsEstatePlanning and WealthAdvisors.com. Thanks.